Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Scott Nations, president of Nations Indexes. We're here to discuss just how much volatility traders are expecting and if their assumptions could perhaps be too complacent. We'll also take a look at some moves in the bond market as well. Scott, it's great to have you as always. Thank you so much for joining us. You've noticed some data that combined with the increase that we're seeing in volatility that suggests perhaps traders are a little bit more complacent than you would have expected them to be.
That's right. Given that there's so much going on today and that none of it is good, you would expect, and given the fact the S&P is down more than 3% right now, you would expect implied volatility, that is option costs and fear, to be higher, and it certainly is. But the interesting thing, Jill, is that the price of at-the-money options is quite a bit higher. But throughout the course of the day, the cost of deep out-of-the-money puts, the sort of puts that would protect against a tail event or a really dramatic decrease in price, have been trailing. That is, traders are not buying those up. Hedgers are not buying those up to the degree that they're buying at the money. And how do we look at this? I look at the money implied volatility by looking at Voldex, that's ticker symbol VOLI. And it's up quite a bit today, again, as you would expect. But Taildex, ticker TDEX, uh, early in the day was actually lower, and it measures the normalized cost of those three standard deviation out of the money puts with a 30-day expiry. Uh, those are up substantially less than Voldex. And what's that tell you? It tells you that investors expect a reasonable amount of volatility. That's why at the money options are more expensive. But they don't expect some sort of dramatic decline, some sort of tail event, some sort of black swan event. And that's why they're not willing to reach out and buy those deep out of the money puts. Jill, I think given what's going on, and to the degree that we could have some sort of miscalculation either in the geoeconomic landscape or the geopolitical landscape, I think it's a little foolhardy to think that we're not going to have and to bet against a really dramatic drop in equity prices. Doesn't mean it's going to happen. That's not what I'm saying. But to not hedge against that doesn't make a whole lot of sense to me right now.
Yeah, and Scott, I would agree with you. Even if we do get to the other side of this, and to your point, there could be a miscalculation. We don't understand what the path is going to be. We don't understand what the desired outcome is. So there could just be a miscalculation inherently because we don't know what that path of execution is going to look like. You also noted that the weakness in bond prices and the weakness in equities is also striking to you as well.
It is. I lived through the crash of 1987 when we saw the first really dramatic flight to quality when the equity market collapsed. And since then, that has been standard. When equity prices really got ugly, people would flee for the safety of treasuries. And that has not happened this month. In fact, even though the S&P is down nearly 3.5% right now, 30-year bond prices are down a point and a half. The yield on those is up 10 basis points. And that's a very different scenario than what we've seen in the past. It means that what used to work as far as diversification is not working now. Why is this the case right now? I think that it's the fact that if you're an international investor, your default right now is going to be sell the United States. If there's a US denominated asset out there, you don't want any part of it. That includes equities and it includes US Treasury bonds.
Yeah, and that's kind of the challenge is, Scott, because a lot of our debt is held by other nations, right? And if we're perceived to be as unstable, which is interesting because you'd always think about international emerging markets, geopolitical risk, and now that is part of the calculus for investing in the US. I never thought I'd be saying these words in 2025, but the longer term implications of that is the market is going to remain unsettled. Alliances are changing, trade policies are changing, and we still don't understand what the end goal is there. So I don't necessarily think, and of course, it's a speculation on my part, that this is a short-term one and done issue. And not to be overly dramatic, but I think there are going to be some longer term effects and fallout, in terms of what our policy is going to look like based on how erratic it's been just, in the past 8, 9 weeks.
That's right. And I think right now it's just a general consensus that for fundamental reasons, nobody wants to own US assets. And that's perfectly reasonable for international investors to be thinking right now. In the long run, 50, 100 years, they're going to be wrong. But right now, they just don't want to own anything. there's also a weakness that we have, a strategic weakness we have in that our, we'll call them counterparties, you might call them adversaries, in any kind of tariff battle often own a tremendous amount of our US Treasury debt. I don't believe that they are yet using that as a weapon, but God only knows what happens if they decide to. And remember that the leadership in China does not answer to an electorate. They are able to pursue their policies without having to listen to an electorate or public opinion. And so I think we're a long way from them using treasuries as a strategic weapon, because that would be a whole different situation. But to the degree that some are afraid that they could, well, then they have to calculate that into their investment thesis.
Right. And this is why investors are nervous based on what they're seeing in the bond market,
Yeah.
because that's really what's being reflected there, that you're seeing that selling.
That's right. And this is the reason that it is very different. We're not seeing a flight to quality this time, is that again, everybody's selling United States assets and they've decided that maybe they want to own European debt, maybe they want to own Swiss debt, maybe they want to own gold, maybe they want to own something very different. It's a very different scenario than what we would normally see in this situation, where over time, U.S. Treasury instruments have been the gold standard when it came to risk-free assets.
Yeah, and I'm glad that you bring that up because we tend to hear so much about at some point the valuations in US stocks are going to get attractive and the fundamentals for companies that can operate in this environment, they'll be rewarded. And while it's encouraging to hear in the short term once we get some sort of resolution, what's happening with the bond market and how not that it could be manipulated, that's not the right word, but how it can almost be a tool within this trade war to me it is pretty concerning.
Yeah, and it should be. Again, uh, investors are at a tremendous disadvantage when markets are moved, whether it's equity markets or fixed income markets, by things beyond fundamentals.
Right.
We know that even when stocks are moved primarily by fundamentals, we know that they're going to be volatile, and that's fine. You're compensated for that sort of risk when you own equities. But to the degree that both of these asset classes are going to be moved by things other than fundamentals, that is risk for which holders, investors, are not compensated because it's so unusual, it's so unexpected. There's no premium built into the return to compensate you for that. I think that's the really dangerous thing for the let's say for the remainder of the year, Jill.
All right, Scott, appreciate the insight as always.
Thanks.
Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.